Hello, everybody. This is Shecky at the High Return Real Estate Show, along with my amazing partner, Mr. Jack Gibson. How you doing, Jack?
Great, Shecky. As always, excited to be here with everybody, and I can't wait for this podcast.
Yeah, we got some really juicy stuff. So we'll be right back. Stay tuned because we are about to blow your mind today. Welcome to the High Return Real Estate Show, the podcast for heavy hitters. 2 men, 1 mission. It's time to build your empire. All right, welcome everybody. We have got a really great show for you today called Funding Secrets of the Top Investors. So there is some stuff that we're going to talk about today that some of you may know about, but there's maybe some hidden stuff in there too. And I know that if you've been listening to some of our previous podcasts, you understand that it really makes a lot of sense to fund your properties with cash so that you can get the best price and the highest ROI. But, as you know, Jack, we get calls all the time like, I get it, I want to do that, but what do you do if you can't pay cash? And that's a fairly common situation. I don't even want to use the word problem because after today, you're going to see that that is not a problem. So today we're going to talk a lot, actually about 6 different ways to become really resourceful to be able to get the cash that you need to do the deals that you want to do, right? So by the end of the show, you are going to have options. You're going to have more ways to do deals than you thought. And that's what this is all about, right? Because the more deals you can do, the faster you can generate wealth and create the life that you deserve. So first of all, let's talk about more the obvious, right? So cash. We want to generate cash, but the conversation here is really not so much looking between the cushions of your couch, but where might there be cash that you had not thought of? Well, there may be stuff in your savings account. You may have some extra laying around in low interest checking accounts, right? But oftentimes people will put cash in their safety deposit box. So do you have any sitting there? We are also, as we record this, we're at that time of year when a lot of people are getting tax returns. So there may be some money coming back from a tax return. I myself own some cryptocurrency. It's interesting because actually the value of Bitcoin, for example, against US currency has risen dramatically over the last few weeks. And so there may be money sitting out there in some sort of cryptocurrency that you forgot about. Maybe there's a savings bond sitting in your safety deposit box, and oftentimes precious metals. And those are always worth money, and they're fairly easy to get cash for. The other thing you may want to consider is, hey, if somebody owes you money right now it's the time to collect. There's nothing wrong with asking somebody who owes you money if they can at least make some sort of small payment or gesture towards paying you back. Because again, we all recognize that buying with cash upfront is what's going to give you the best pricing and therefore the best ROI.
Yeah, Shecky. And, one other thought is, what do you own that's a liability that's not serving you financially? It could be, these are where we get real emotionally attached and people start to freak out with the thought of parting with their, motorcycle or their jet skis or their snowmobiles or their way too much car that they, took a loan for or whatnot, or even have cash tied up in a car.
Yeah.
And items that you have that you can sell and liquidate and create cash. I mean, I know a young guy that I was mentoring, Shecky, just a few months ago. He had a car. He's like 22, 23. He had a car for $28,000, paying $900 a month on that car.
Jeez.
Yeah, and it's his second car. I'm like, you kid, you're crazy. Sell the car. And
yeah, it's interesting because a lot of the things that fall into that line of what we would call toys is so crazy ego-driven. And, it's like, I've got to have this. I've got to look good. It's all about, the way you're portraying yourself to society. And I don't necessarily want to turn this whole podcast into a personal development seminar, but I want to really impress upon the listeners that, look, if you can just set aside your ego and just think in terms of common sense about things that you don't necessarily need to have, and practice in a principle of a little bit of delayed gratification for this stuff, there's so much leverage in real estate that can just get you to a point where you can drive any car you want. You can have whatever toys you want, and it doesn't really take that long. So, people that are wealthy and that have a wealth mindset are buying assets that can produce income. People that do not have a wealth mindset are buying things that are liabilities, right? They're buying things that feed their ego. So again, not a criticism, but I really want to ask the listeners to take a hard look at yourself and what are the things that you are spending money on right now that are liabilities versus assets. What are you serving? Are you serving your future, or are you serving your current ego? It's just not a judgment. It's just a question. And it's an important one to ask yourself, because I think it'll really help you move forward. Right?
Yeah, Chicky, I don't know any other way to be successful in real estate except to delay gratification. We have to be able to have the discipline to put off buying the things that we can buy, but being financially responsible and thinking about building wealth and building a real estate portfolio that can pay you for the rest of your life and then pass on to your children and their children's children. You're going to have to delay the purchase of those toys and those really nice material objects. I've got a really nice car, Shecky. I mean, you've been in the Tesla. It's
beautiful.
It's a beautiful car. But up until just a few months ago, I was driving a car with 130,000 miles on it, probably worth $4,000 or $5,000 is what I could sell it for right now.
Yeah, and I was in that car, and you were already generating some really, really nice income while you were driving around in that old car.
Yeah, but I wanted to build my real estate portfolio first before I bought the really nice stuff. I wanted to feel good about, hey, you know what? I was financially responsible. Now my assets, my financial assets, aka my real estate portfolio, is paying for the monthly payment on my Tesla. And it's great. I don't have to work every month or get out of bed every morning to work, create income to pay for that payment. It's automatically paid for by my tenants paying their rent. So just a different philosophy, just asking you guys to consider as you listen to this. So,
hey, let me ask you a question before you jump forward. Let me ask you a question, philosophically speaking.
Oh boy.
Would you say would you say that as a result of knowing that the Tesla payment is paid for by your real estate investments, that the experience of getting behind the wheel of that car is just that much sweeter?
Shecky, that's certainly a great question. And I'd say 100% emphatically yes. I mean, I had a BMW 330, I was 22 years old right out of college. I'd built up a nice, nutrition supplement distribution business and was making, pretty good money. Not, nothing great, but I bought a more car than what I should have. Right. And which was the BMW. And I was, after about a year, the first year was kind of cool. And then after that, it just started wearing on me that I was making these huge payments on a car that was way more than what I really should have had. And so that driving experience just wasn't all that great. And now you are absolutely right. Every time I get into that car, it's just a relaxed feeling of just, hey, enjoy this car. And not that I don't have this attachment to material objects. Cars it's not that high up on my goal list, but I like nice things, and
sure,
I like to experience the best that life has to offer. And I can do it now, really guilt-free. Like, hey, this is because I waited for this. I delayed gratification for this.
Yep.
So, that's a great question, Shecky. So yeah, number one is cash. So number two, guys, is a HELOC. This is one of my favorites. This worked out really well for me. I think you guys probably already know this, but a HELOC is a home equity line of credit. And it's a fantastic way to tap into the unused equity that's currently in your house. It's really not making you any money. Yes, it gives you that comfortable feeling of knowing that you have equity in your home, but you're able to borrow money out of your house, and instead of using it like an ATM to buy things that, you really shouldn't be buying. That's how most people, use their HELOCs and, the early 2000s, and then it really came back to bite them in a big way in 2007 and 8. So we're talking about actually taking the money out and using it to create more wealth. You can borrow, a lot of times you can borrow out of your HELOC at, right around 5%, maybe 5.5%. Interest rates are going up a little bit, but somewhere right around there, and get an interest-only loan on your HELOC. So think of it this way, you're borrowing at 5%. Now, if you can find an asset that's paying you out 15%, 16, 17% net cash flow, safe and secure every month, now you're making a spread of that, say, 10%. So if you're borrowing at 5 and you're making 15%, now you have a 10% profit spread. So now all of a sudden that, 50, or let's use easy math, $100,000 in equity that you borrow, now you're making $10,000 in net extra cash flow per year by simply just tapping into this equity. So I don't particularly like equity, Shecky. I'm actually, it's funny, I like depreciation much better than I like equity.
Yeah.
I like debt more than I do equity, because with responsible debt, now I can actually harness the power of that money and put it to work. So when you close your HELOC, and most of them usually take about 30 days, it's a very simple process. They'll more than likely do an appraisal on your current house, get a value, and then whatever the difference is between what you currently owe on your property and then the appraised value, you're going to be able to tap usually around 90, 95% of that total equity you'll be able to pull out in the form of the HELOC. When the HELOC closes, you can pick up a check and then deposit those funds into your bank account. And then you can pay the HELOC off at any time, and borrow it back at any time. It's a line of credit, interest only. So it's very flexible, but when that HELOC closes, you've got basically cash in your bank account that you can then use and go out and purchase properties at a discount, or you have more options, as we talked about on our last podcast, where you can go out and buy a property and fix it up and create a lot more equity position and a lot more ROI in that property. So it just gives you a lot more purchasing power when you pull this out. So it's probably one of my favorite ways to be able to purchase property in cash. So then the next way that I think is great is liquidating stocks, right? Yeah. So here's what a lot of people don't understand about the stock market is that they don't adjust their profit or their returns, their ROI. They don't adjust it for risk. Okay, so the historical stock market variance, meaning the degree of which it swings over the course of time, is 16. Okay, now real estate has a variance of 4. It basically just means the level of which that it's going to fluctuate in price, over the course of a long period of time. So think about that. Stock market is 4 times as risky as real estate. Now, over the long haul, right? We know the stock market returns. There's arguments that it's 8%. Most of the experts that I talk to say it's a 6% historical rate of return. So if you're finding real estate properties where they're getting a consistent yield of 13, 15, 18%, you're talking about a really, really high ROI with a much, much lower variance or risk level. So your adjusted risk ROI is between your real estate portfolio and your stocks is just, I mean, it's night and day. It's not even close.
Yep.
So with cash flowing real estate being at such a really low risk level, plus it's backed by the deed of the property. You own something real, right? It's real estate. It's tangible. You can touch it, right?
Yeah, that's just so flippin' huge because
It's going to be here 100 years from now, right, Shecky? I mean,
well, yeah. I mean, like if you look at what the way stocks are, I mean, essentially it's backed by a piece of paper, right? Like it's not even a stock certificate anymore. It's just something digital that ends up in your trading account, right? And what makes that have value is essentially it's backed by the confidence that there's a market for that certificate. It doesn't necessarily mean it's going to sell for that. The other thing that I find really interesting about stocks is that in order for you to make a decision about a stock, you can look at all kinds of stuff and PE ratios and all those things, but every stock obviously is coming from some sort of different industry. When we look at real estate, we know that it's, what we affectionately call bricks and sticks, right? I mean, we know that it is what it is. I hate that expression, but I just said it. But we're going to put a renter in there. The guy's going to have a roof over his head, right? He's going to be able to get to work. We're going to charge rent. That's it. There's nothing more complex than that. Like any single property essentially stands on its own merit, but you don't have to look at like all these different nuances of, well, this is so much more of a volatile type industry that we're in. We're in the energy sector, or we're in the tech sector, or we're in the manufacturing sector. Like, we don't have to make any of those decisions. All we have to do is look and say, okay, is this a property that makes sense? Am I buying it right? When I have a renter in there, can I get some really, really nice ROI? That's it. There's nothing more complex about it than that. And if you ever need to get out, and granted, Jack, I know that we're very heavy into the buy and hold side of things, and there's lots of arguments for that. But if for whatever reason you need to get out, you have something absolutely tangible to sell. You have the deed of that property, and there is always going to be a market for it, especially if it's a performing asset. It becomes very, very easy to sell to another investor.
Very true. Stocks can go to zero.
Oh, yeah.
Real estate can't go to zero. It really can, unless the property burns down and you have no insurance, which obviously you guys are, obviously smart. You're not going to buy a property without insurance. So you're protected. You're very protected. I mean, even in the worst, stock or real estate debacle in 2007 and 8, was it the biggest drop was in like 30% or something? I mean, stocks can swing a lot more than that. So obviously, we're very, very pro real estate. So I'm going to move on. Number 4 is a self-directed IRA or a 401k.
Yeah, this is my favorite one because this is one that a lot of people don't consider, right? The stat that I just find so interesting, right, is that 97% of all the funds in retirement accounts are in investments other than real estate. Like your typical 401k in America is you're paying somebody to quote unquote direct that for you. They're putting you into these sort of blase, relatively safe mutual funds and things like that. And by the time that you pay their fees, what are you making? 2, 3, 5, 6%? And you're still invested in funds that, even as a mutual fund, there's still some volatility to it. It's still just a group of those same stock certificates that we just talked about a few minutes ago. What most people don't realize is that there is a special kind of retirement account in the US that allows you to be self-directed. Those are the key words, right? And if any of the listeners have more questions about it, you're happy to write to us and go on our site. It's no problem. We're happy to explain it further. And honestly, Jack, as you know, that could be a whole nother podcast that I think we should do, is just talking about all the nuances of what does self-directed mean.
Yeah, we need to get my lawyer on that set up the plan docs for me, and he is so resourceful on this. Great podcast we've got to have Chucky coming up.
Yeah, absolutely. But the cool thing is that you can set up an IRA that you direct yourself. And real estate is considered a legal instrument for you to invest in and out of within your 401k. So think about this. This is money that's sitting there that you forgot, you didn't think you had until we brought it up, that can be used for investing. Don't let it just sit there, right? So it's not very difficult to change whatever account you have over from a typical 401k to a self-directed and leverage that to invest in real estate. So if you're starting to invest in, say, a 15, 16, 17, 18% ROI property, that is so much more vastly different than investing in those mutual funds. And you push that out there for 5, 6, 7, 8 years, and the difference in what your 401k is worth in a few years is just so ridiculously significant. So this is something to plan for your future. Now, there are a few, sort of, I guess, qualifiers, right? Like you need a new set of plan docs. I know your broker did a really nice job for you on that. And you, to a certain extent, sometimes have or don't have a quote unquote checkbook that you control, because there are certain transactions that, you can and can't do outside of that account, right? So suffice it to say, the IRS rules state that all transactions for that property, when I say all, I mean the revenues and the expenses for that real estate investment, must go in and out of that self-directed IRA. They must, right? Like even if you buy a nail at Sears to go, put it, hammer up a nail on that property, it's got to be paid for out of the self-directed IRA. And as long as you're doing things correctly, again, you're doing out of an account that has no tax implications. Right? So you start making a bunch of money in your IRA, you're not paying tax on it until retirement time. It can be really, really, really powerful way to build wealth.
Yeah, this is something that I did about, a year and a half ago. I didn't even know about it. I was listening to a podcast just like this and got educated.
Yeah.
I'd never even heard or had the inclination, slightest idea that I could actually purchase real estate out of my 401k. Because when I went to my broker and asked him about this, if I could do this at my brokerage, he didn't even know what it was. He'd never heard of a self-directed IRA or 401k. And he's a great guy. I mean, he's definitely, I feel like my broker has my best interest at heart. So I look at him as a fiduciary. He's always felt like he never wanted to make a commission. He lowers his commission on me. So even somebody that's really got their client's best interest at heart, he didn't know. And I'd say that's probably the vast majority of brokers. They don't know. So all they know is that inside your 401k or IRA, they're going to put you into stocks and, and mutual funds. So this is something that people are just simply not educated about. So you absolutely have the ability to liquidate all the stocks inside your 401k or IRA and transfer that into a new entity. You'd have to have a new set of plan docs, created and drafted up, by a lawyer. And then you can do that. You can transfer all the money over into that new plan. And then you have complete control over what you buy. You can buy stocks inside that self-directed IRAs, but you can also buy, bonds. You can buy and real estate and a lot of different things open up inside that self-directed IRA. So yeah, definitely. You need to consult with a lawyer. If you'd like a referral, I can refer you to my lawyer, Tim. He's been incredible, and he only charges maybe I think it was like $800, $900 to set up the plan. So it's really not that expensive. And then he kind of guides you on what to do, what transactions, and how to track and make sure that you fall inside the IRS rules and parameters.
Yeah, so, for sure.
Let's talk about the fifth one, private money.
Yeah, good stuff. So there's plenty of money out there in the world. There's plenty out there that private individuals have and want to invest. and don't really necessarily have good places to do that, right? I mean, we talked about some of the volatility of the stock market, but there are plenty of people, plenty of retirees too. I'll give you a really great example. Okay, so my mom is, Mom, if you're listening, I love you. My mom is, God love her, she's 81 years old.
She's not going to listen to this podcast.
No, I'm going to make her listen. So, but she's 81 years old. And, you know, salty as heck, still got lots of personality, very lucid. You know, my dad's been gone for a while. Left her, you know, not a lot. I mean, you know, there's a certain level of comfort, but it's, you know, it's definitely, you know, nothing stellar. You know, it's very middle class. So she's always just looking for ways to be safe and protect herself going forward. And so I talked to her one night. I was at her house and we were just talking about investing, and, you know, she knew that I was very excited about real estate. And I said, God, Mom, you know, we've got properties that we can do like 15, 16, 18%. And they're all turnkey. Like, you don't have to do anything, right? You could just make that kind of return. And as nice as my mom is, she goes on this flippin' tirade. Like, I'm too old and I don't ever want to own a property and all this other kind of stuff, right? And I'm like, wow, okay. I didn't, like, there was a lot of emotion in that conversation. And, you know, granted, you know, everybody's got a different perspective. So, you know, an 81-year-old female who's retired and is getting on in years and isn't really, you know, necessarily in perfect health, obviously has a different perspective than, you know, what I have or what you may have, right? So I certainly want to respect that perspective, but it just, when she went off on that tirade, it kind of just struck a chord with me. And I must have said the right thing, because like I said, hey, Mom, just an idea, like, you know, you obviously know that real estate is safe. She goes, yeah, I know real estate is safe. And obviously you got renters and people are paying. And even if you lose a renter, you're going to get another one. I mean, you know, you've always got something that can generate cash. And she goes, no, I get it. I don't want to own the real estate. I said, what if you were able to invest some money in such a way that you were protected by the real estate without owning it? And she's like, well, what do you mean? And I said, well, look, there's a couple properties that I'm really interested in, and I'm happy to pay you, you know, a fair percentage, 8, 9, 10, 12%, whatever it was at the time, I don't remember. And I'll make a nice, you know, we could do it like on 15 years. It doesn't have to be a 30-year amortization. I know you're an older lady, right? And I'll make payments to you. You hold a mortgage. You hold a note on the property that you are protected by the deed of the property. So if for whatever reason I don't pay you, then you automatically end up with the property, but you're starting off with equity to begin with. And, you know, if you ever had to, you could sell it and cash out. And she goes, that sounds really good. Like, how much could I make? Like, if I gave you X amount of dollars. So it was a really simple conversation. We just got online and went on one of those free, you know, amortization things and played around with a couple scenarios. And literally 5 minutes later, she's going, okay, I'll do that one. I'm like, okay, I'm not going to ask again. Like, this is beautiful for both of us. Well, it's beautiful for both of us, right? Because it's my mom, right? So I want her to be in the absolute safest position no matter what, right? I want her to make a good return. But this is win-win, right? Because I'm buying properties that are yielding 16 to 18%. You know, I'm paying her, let's just say 8. I don't remember what the exact numbers were, but there was plenty of spread on those properties for me to make a nice monthly revenue and for her to make a nice monthly revenue. And it's so beautiful. Those checks get automated to her every month. And then the checks for the rent get automated to me. And I always go in and look at the difference and go, this is flipping fantastic. So I tell this story because I want the listeners to understand that I don't think that my mom is an anomaly. I think that that's pretty typical of a lot of older people in America that are not getting treated well by their the people that are managing the retirement accounts. They're getting bilked to death on fees. They for sure do not necessarily want to own property, but there is an opportunity there for you to not only gain the cash that you need to go out and buy more properties, but there's an opportunity for you to provide a good service to them, to put them into a financial instrument that makes sense for them when they are older. So just something to think about. I think that's a not used nearly enough as that kind of private money.
Yeah, I mean, same thing here, Shecky. I mean, just definitely different situation. Wasn't my mom, and I love that story too. It's absolutely win-win. I mean, it's killer. And my landlords, where I rent a space from in a little strip mall for our other nutrition distribution business, and I knew what they bought our building for, over a couple million, and knew that they were getting, right around the 9-10% cap rate. So I offered them, a deal where they could loan me hard money, and then I'd go out and buy property, and that their money would be secured by real estate. It would be backed by the deeds on the property. And so they're winning, they're getting a, north of 10%, and I'm winning because I'm making that spread. Now, I have my own funds as well, but I know I'm in control of this investment. I'm very comfortable paying out the 10% plus to them, and I'm getting the difference between what the rents come in at every month. So there are lots of people out there like this that would love to deploy their money in a much safer way, backed by a hard asset like real estate. So you gotta, now this one takes some work. It takes a network. Sure. Robert Kiyosaki always says the rich build networks and everyone else looks for work.
Yeah.
Interesting, huh?
Yeah. So, and even though you may do a little bit of work up front with networking, the fact that you say win-win is really true. But the other thing that's really cool is that when you have private money in a real estate deal, it's really simple, like ability to close quickly. When I did that deal with my mom, there was 2 extra pieces of paper in the closing documents. I wasn't jumping through any hoops or doing income qualifiers or looking at my FICO score or any of that stuff, right? And so anywhere that you get private money, especially if they know you, there's none of those hoops to jump through. And so again, it speaks to your ability to go in and do a deal and get the best deal up front. Like you're telling somebody, hey, not only can I pay cash, but I can close quickly without a whole bunch of extra paperwork. And that's really, really attractive to any seller. So it's just something to keep in mind. It's, you have a lot of ease of doing deals when you do it this way.
Yes. So let's talk about the 6th way, and certainly there's more than 6. These are our top 6.
Yeah.
So this way is, we're going to just confess we're definitely very excited about this, but we're also very new at it. So we would highly encourage you to do your own research. We're not endorsing this as a method, but we want to open up possibilities for you in your creative financing endeavors. So the 6th one is credit card introductory lines of credit. Now, think about how many times over the course of your lifetime where you've gotten in the mail a credit card offer for 0% interest for, say, 12 months. Sometimes they go a little longer to 18 months, but usually not much longer than that. And a lot of times, those are very, very enticing. And why do they do that? Well, of course, they're trying to get you to once they get you as a buyer one time, then they realize you're probably going to keep the card and statistically going to, put on a balance, and and you're then eventually going to start paying some interest after that introductory term is over.
Yeah.
So what you can do is you can actually leverage with a company that has expertise and specializes in finding you these lines of credit that you can then convert into cash, and how you can maximize these lines of credit to get you multiple offers. So in some cases, anywhere from 50,000 over the course of a year, up all the way up to, I've heard, $250,000 or more. And then once that, everybody's question is always, okay, what happens when that 12 months is over? What do we do then? Are we up to 15% interest on that card? No, actually, you just renew with that company, and then they'll roll your balance into a different, new 0% introductory line of credit with a different credit card company. And so they know what they're doing. They specialize in this, and so you're getting some obviously incredible terms. I mean, you can't get any better than 0%, right?
Right.
So what I'd encourage you guys to do, check back with us once we've done more research into these companies. I've actually made an application, put the initial down payment on with a company, and I'm going through the consultation approach. I've got my consultation call here next week. So stay tuned, and send me an email if you'd like to be the first to know how this turns out, and if you'd like a recommendation to the company that I'm aligning with. My email is jack@highreturnrealestate.com. So like I said, stay tuned. We'll have more information on this as we continue to do more research, and certainly don't want anybody to go out and do this until we've kind of vetted it ourselves.
Yeah, but I will say from what you and I have talked about, Jack, it looks really promising, and it dovetails super nicely into a long-term strategy. And so, what I mean by that is this entire podcast, we really talked about the best way to get into a property. But one of the things we didn't talk about, and I feel like we need to kind of tie a bow on this podcast as we wrap it up, is let's talk about keeping these properties, because most of our listeners are buy and hold strategists. So let's do that. Let's keep in mind that all of these strategies work really well with a cash out refinance strategy once the property is seasoned. So whether that's somebody else's cash, or a credit card, or leveraging other stuff that you have elsewhere, or heck, even money that's sitting in a mattress, whatever, right? And all that seasoned means for these cash out refis is that the property has been proven to produce income for some period of time, typically a short period of time. Most lenders look at a seasoning period anywhere. I've seen it as low as 1 month, and I've seen it as high as 12 months. The average is typically somewhere in the middle, right? But the cool thing is this back end, and we kind of call it the back end because it's kind of cashing back out whatever your means of getting into the property was. This is the best place to harness the power of a traditional lender. A regular old bank. They like these kinds of deals. Now, why do they like these kinds of deals? Because that's what they mean by seasoning. It's like, okay, look, you're showing them I've already got a property that's performing, right? I own it. I have the deed to the property, and I've got rental income coming in. So a bank looks at that and goes, okay, as an example, this cat's got, a duplex that's pulling in, $1,100 a month between both sides. And basically he's asking to refinance the property, and the payment's only $400. So even if he loses, this is the banker thinking now, even if he loses one of his renters, he's only got half the place, half the duplex rented, he can still make the payment on this loan. All right, so for them, it's kind of a no-brainer. So I want to encourage all the listeners to think about this in terms of a kind of a two-pronged strategy. Leverage one of the things we taught you about getting into the property, what the main focus of this podcast was. Do your cash out refi after that, after it's seasoned, and then pay off your original method of getting in the property so that you can free up that cash. So freeing up that cash, what does it allow you to do? It allows you to buy more, right? And you can go back in that next property and do the same thing, season that, rinse and repeat. This is this is how many of our investors are building huge portfolios and just creating gargantuan amount of wealth. And, there's no question we could talk for a long time about the nuances of that cash out refi strategy. And Jack, just, I know we have to do a podcast.
I was just going to say that this is a definite podcast coming up next.
Yeah, absolutely. So stay tuned. I don't know if it'll necessarily be our next one, but I think we should do that really, really soon. So anyway, if you got value out of this podcast, please share it. Please leave us a 5-star review. That does make a difference. It's only a couple mouse clicks for you, so we really appreciate it. But that's the kind of stuff that gets other people, gets the information that we're putting out exposed to other people that need this and may not otherwise see it. So, and now that you know the easiest ways to get into these properties, now that we've covered that today, I just want to remind you, listeners, that any of the properties on our site, any of them, will give you the ROI to achieve those spreads that we discussed. So I want to encourage you, just head on over to highreturnrealestate.com, click on the properties tab, and have a look. And of course, if you got any questions at all, please feel free to reach out to us. And Jack, as always, it has been an absolute pleasure, and I always love doing this with you. And thank you for your insights and your friendship and your leadership. It's awesome.
Yeah, thanks, Shecky, everybody. Thanks so much for listening. Stay tuned for more incredible content. Well, at least we think it's incredible. So you guys actually get to vote on that with whether you listen to us or not. So definitely appreciate all of you as listeners. Please feel free to email us at any time with any questions, anything that we can help you with. And we look forward to continuing to serve you up some great content. Have a great day, everybody.